Preemptive Infrastructure Theory. Why China's high-speed rail succeeded until it didn't. Summary statement. China's high-speed rail network demonstrates both the promise and the limits of building infrastructure ahead of demand. Its early success came from connecting economically productive regions where demand, utility, and monetization were already strong. Its later difficulties emerged when expansion increasingly relied on debt rather than self-sustaining economic foundations. Using preemptive infrastructure theory and its rule of priority as an analytical framework, this paper examines where China's strategy created enduring national value, where it crossed into speculative overbuild, and what lessons policymakers can draw when distinguishing strategic infrastructure from costly overinvestment. Section 1. Pinpoint position. Infrastructure has traditionally been evaluated using a straightforward question: does the project generate sufficient financial returns to justify its cost? For commercial enterprises, this is an entirely reasonable metric. A railway is expected to sell enough tickets to recover its operating expenses, service its debt, maintain its assets, and eventually generate an acceptable return on capital. If it consistently fails to do so, the investment is generally regarded as unsuccessful. China's high-speed rail network challenges this conventional way of thinking. Despite constructing the world's largest high-speed rail system, now exceeding 50,000 kilometers of track and connecting approximately 97% of Chinese cities with populations above 500,000, only a small proportion of the network consistently generates direct operating profits. Meanwhile, China State Railway carries debt measured in the hundreds of billions of United States dollars, prompting growing discussion within China itself regarding the long-term sustainability of continued expansion. These observations appear, at first glance, to suggest a failed investment strategy. Yet this conclusion feels incomplete. The railway has also transformed labor mobility, reduced travel times across vast regions, strengthened economic integration between coastal and inland provinces, expanded domestic tourism, encouraged industrial clustering, and connected hundreds of millions of people into a far more cohesive national economy. Judged solely by ticket revenue, much of the network appears financially weak. Judged by its wider economic effects, it has reshaped China. This apparent contradiction raises a more fundamental question: how should strategically important infrastructure actually be evaluated? This paper argues that neither extreme provides a satisfactory answer. On one hand, evaluating infrastructure exclusively by direct commercial profitability ignores the broader economic systems that infrastructure enables. On the other, justifying indefinite operating losses through vague appeals to future productivity risks encouraging inefficient capital allocation and uncontrolled debt accumulation. Preemptive infrastructure theory seeks to establish a disciplined middle ground. Rather than viewing infrastructure as either a conventional commercial investment or an unlimited public subsidy, PIT proposes that transformative infrastructure should satisfy two conditions simultaneously. First, it must generate meaningful utility, revenue, or strategic advantage from the moment it becomes operational. Infrastructure should begin contributing immediately, rather than depending entirely upon speculative future outcomes for its justification. Second, that same infrastructure should create future optionality by enabling economic activities, industries, or coordination mechanisms that could not previously exist. The greatest infrastructure investments rarely deliver their full value at the moment they are completed. Instead, they become platforms upon which future innovation compounds. This relationship is governed by what PIT describes as the rule of priority. Before exploratory expansion is pursued, the downside must first be protected. In practical terms, this means the underlying infrastructure should possess sufficient present-day utility or monetization to sustain itself before large-scale optionality is pursued. Future opportunity should be built upon secured foundations rather than financed by increasingly speculative assumptions. The rule of priority distinguishes preemptive infrastructure theory from conventional, build it and they will come philosophies. PIT does not advocate constructing infrastructure simply because future demand might eventually appear. Instead, it argues that durable infrastructure combines immediate usefulness with long-term strategic potential while maintaining disciplined protection against downside risk. Viewed through this framework, China's high-speed rail network becomes something more valuable than either a success story or a failure. It becomes a stress test. Its earliest phases demonstrate many of the characteristics associated with disciplined preemptive infrastructure. Dense economic corridors generated immediate passenger demand, high utilization, measurable productivity gains, and substantial commercial revenues. In these regions, infrastructure reduced friction while simultaneously paying for itself. Later phases present a different picture. Expansion into lower density regions increasingly relied upon expectations of future development rather than demonstrable present-day monetization. As maintenance obligations, debt burdens, and operating losses accumulated, concerns emerged regarding whether parts of the network had crossed the boundary, separating strategic foresight from speculative overextension. The purpose of this paper is therefore not to determine whether China's railway was right or wrong. Instead, it asks a more useful question. At what point does preemptive infrastructure cease being disciplined investment and become speculative infrastructure? China's experience provides an opportunity to examine that boundary with unusual clarity. In doing so, it offers lessons that extend well beyond transport policy into broader discussions surrounding artificial intelligence infrastructure, semiconductor manufacturing, energy systems, digital networks, tokenization, and other foundational technologies that seek to shape tomorrow's economy while operating within today's financial constraints. Section 2 of 4. Contextual cloud. To understand preemptive infrastructure theory, it is first necessary to understand the philosophy it challenges. For most of modern economic history, infrastructure has been treated as a response to demonstrated demand. Roads are widened after congestion appears. Airports expand after passenger numbers increase. Electricity grids are reinforced after consumption begins approaching capacity. In each case, infrastructure follows demand. The investment is justified because existing economic activity has already demonstrated a measurable need. This demand-led model is sensible. It minimizes wasted capital, limits financial risk, and provides relatively straightforward methods of evaluating investment through cost-benefit analysis, projected cash flows, and expected rates of return. Yet, history also provides numerous examples where infrastructure did not simply respond to economic development. It actively created it. The interstate highway system in the United States reshaped suburban growth and national logistics. The containerization of global shipping dramatically reduced transportation costs while reorganizing international trade. The Internet's underlying protocols existed years before electronic commerce, social media, cloud computing, or artificial intelligence emerged. Google's systematic indexing of the world's information initially enhanced search, but later became one of the foundational data assets underpinning modern artificial intelligence systems. In each case, infrastructure became more than a utility. It became a platform. The distinction matters because platforms behave differently from traditional projects. A conventional project creates value primarily through its own operations. A platform creates value by enabling countless activities that occur above it. Roads enable commerce. Electricity enables industry. Telecommunications enable coordination. Payment networks enable markets. Blockchains enable programmable ownership and settlement. Infrastructure increasingly functions as an operating system for economic activity rather than merely a collection of physical assets. This observation leads naturally toward the central intuition behind preemptive infrastructure theory. Rather than asking, what demand exists today, PIT asks, what future economy becomes possible if this infrastructure exists? That question fundamentally changes how infrastructure is evaluated. Importantly, however, PIT does not argue that governments or investors should build first and hope demand eventually appears. That interpretation confuses preemptive infrastructure with speculation. The distinction is critical. Speculation depends upon uncertain future outcomes for its justification. Preemptive infrastructure depends upon present-day utility while simultaneously expanding future opportunity. This is where the rule of priority becomes the defining feature of the theory. The downside must be protected before exploratory expansion is pursued. Infrastructure should already possess sufficient economic utility to sustain itself. Future optionality is then allowed to compound from that secured foundation. This separates PIT from several related, but importantly different, economic ideas. It differs from loss leader economics. A retailer may deliberately sell one product below cost in order to generate profits elsewhere in the business. The individual product is expected to lose money. PIT rejects this logic as a permanent strategy. Infrastructure may generate benefits beyond its immediate revenue stream, but it should not rely indefinitely upon losses being absorbed elsewhere. Sustainable infrastructure should create immediate utility alongside long-term strategic value. It differs from simple industrial policy. Industrial policy often identifies sectors considered strategically important and directs capital toward them. PIT is less concerned with selecting industries than with constructing enabling platforms upon which many industries can develop simultaneously. It also differs from conventional development economics. Traditional infrastructure-led development generally assumes that infrastructure removes existing bottlenecks, preventing growth. PIT goes one step further. It suggests that certain infrastructure can alter the topology of an economy itself by creating entirely new patterns of coordination, interaction, specialization, and capital formation. Infrastructure does not merely accelerate existing markets. Under the right conditions, it changes the shape of those markets. This perspective aligns naturally with concepts from network economics. The value of many networks increases as participation expands. Road systems become more useful as destinations multiply. Telecommunications become more valuable as additional users connect. Payment systems become more attractive as more merchants and consumers adopt them. Digital platforms become increasingly powerful as complementary services emerge. Infrastructure therefore exhibits characteristics that traditional project accounting frequently struggles to capture. Many of its largest benefits are second-order or third-order effects. Reduced travel time becomes greater labor mobility. Labor mobility becomes larger labor markets. Larger labor markets improve specialization. Greater specialization increases productivity. Higher productivity expands tax revenues and private investment. The infrastructure itself may remain unchanged, while the economic system built upon it grows progressively more valuable. These indirect effects explain why infrastructure is frequently described as a public good. However, public good status alone does not justify unlimited investment. Every infrastructure system eventually encounters diminishing returns. Each additional kilometer of railway, transmission line, or fiber network generally contributes less incremental value than the one before it. Recognizing this boundary is precisely why the rule of priority exists. PIT is therefore best understood not as an argument for building more infrastructure. It is an argument for building infrastructure in the correct sequence. Secure the foundation. Establish immediate utility, protect the downside, then expand into future optionality. This sequencing transforms infrastructure from speculative expenditure into disciplined platform construction. China's high-speed rail network provides an unusually revealing environment in which to examine these ideas. Its early expansion connected some of the world's most densely populated and economically productive regions, generating extraordinary passenger volumes, measurable productivity gains, and rapid reductions in travel friction. These characteristics strongly resemble disciplined, preemptive infrastructure, yet later phases increasingly pushed beyond established economic density into regions where immediate monetization weakened, while financial obligations continued to grow. The same network that initially demonstrated the power of strategic infrastructure gradually began revealing the risks associated with expanding beyond economically self-sustaining foundations. Rather than proving or disproving preemptive infrastructure theory, China's railway illustrates something more useful. It demonstrates that infrastructure can move through distinct phases of economic quality. The same project can begin as disciplined platform investment and later evolve into speculative capital allocation if the principles that justified its original success are no longer maintained. This distinction forms the analytical framework for the remainder of this paper. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3 of 4, Section 3. China's high-speed rail as a case study. China's high-speed rail network provides an ideal test case for preemptive infrastructure theory because it contains evidence supporting both its strengths and its limits. Rather than viewing the network as either an overwhelming success or an outright failure, PIT suggests that it should be understood as two distinct phases of infrastructure development. The first phase largely adhered to the principles of disciplined preemptive infrastructure. The second increasingly departed from them. Understanding where this transition occurred is perhaps the most valuable lesson the network has to offer. Phase 1. Strategic success. China's initial objective was neither simply to build trains nor to compete with other countries. It was to reduce the enormous economic friction separating China's prosperous eastern seaboard from its rapidly industrializing interior. By the end of 2025, the network exceeded 50,000 kilometers, connecting approximately 97% of Chinese cities with populations greater than 500,000. More than 4 billion passenger journeys were recorded annually, making it the largest high-speed rail network in the world. These achievements were not simply engineering milestones. They fundamentally changed how people, businesses, and regions interacted. The flagship Beijing-Shanghai corridor illustrates this particularly well. Serving more than 200 million passengers each year, the line generated approximately 12.77 billion yuan, around 1.8 billion United States dollars, in annual net profit, making it one of the few genuinely profitable high-speed rail corridors anywhere in the world. From the perspective of PIT, this represents exactly what preemptive infrastructure should accomplish. The infrastructure produced immediate utility. Passenger demand was already sufficiently concentrated. Travel times fell dramatically. Labor markets expanded. Business travel increased. Regional integration accelerated. Most importantly, the infrastructure generated enough present-day economic activity to justify its continued operation while simultaneously creating future opportunities for further economic development. The rule of priority remained intact. The downside was protected by genuine demand rather than optimistic projections. Future optionality emerged naturally from an already successful foundation. This is precisely what distinguishes disciplined infrastructure from speculation. Phase 2. Strategic overreach. The character of the network gradually changed as expansion accelerated. Rather than concentrating on the country's highest density economic corridors, new lines increasingly reached regions with much lower population density and significantly weaker immediate passenger demand. Construction itself remained extraordinarily impressive. China routinely built high-speed rail at costs estimated between 17 million and 21 million United States dollars per kilometer, substantially below comparable European and American projects. Fixed railway investment approached 900 billion yuan annually as construction continued at unprecedented speed. The engineering problem had been solved. The economic problem became increasingly difficult. By the middle of the 2020s, only a small proportion of the network consistently generated direct operating profits, while China State Railway accumulated debt estimated at approximately 6.2 trillion yuan, roughly 850 billion United States dollars. Estimates suggested that only around 5 to 6% of the high-speed network remained commercially profitable, with many routes unable to recover their operating and financing costs through ticket revenue alone. This is the point at which PIT begins asking different questions from conventional infrastructure analysis. The issue is not whether Western provinces deserve modern transport infrastructure, nor is it whether regional development has value. The question is whether expansion continued after the rule of priority had ceased to hold. Once immediate monetization weakens sufficiently, future optionality alone becomes responsible for justifying present expenditure. At that point, the character of the investment changes. Infrastructure gradually shifts from being economically self-sustaining toward becoming increasingly dependent upon indirect macroeconomic benefits, whose magnitude becomes progressively more difficult to measure. This transition is visible in China's own policy response. In early 2026, approval standards for new intercity high-speed rail projects became noticeably more restrictive. New proposals were expected to demonstrate passenger forecasts of at least 15 million passengers annually, while regions with underperforming networks faced tighter scrutiny before additional expansion could proceed. Perhaps the strongest evidence comes not from foreign critics, but from China itself. The emergence of the gray rhino discussion reflects growing recognition that obvious, foreseeable risks, including rising maintenance costs, mounting debt obligations, and diminishing marginal returns, cannot be ignored indefinitely. From the perspective of preemptive infrastructure theory, this does not demonstrate that building ahead of demand is inherently flawed. It demonstrates something far more specific. China's railway network appears to have crossed the boundary where secured, monetizable infrastructure gave way to increasingly speculative expansion. The first phase demonstrated the power of disciplined platform building. The second illustrates the consequences of extending that platform beyond the point at which its economic foundations remain sufficiently protected. That distinction is the central lesson of the case study. It suggests that successful preemptive infrastructure is not defined by how much is built, but by whether each successive expansion continues to satisfy the rule of priority. Once that discipline is lost, even the world's most impressive infrastructure project can begin evolving from a national operating system into a growing fiscal liability. Section 404, Section 4, Discussion and Conclusions. China's high-speed rail network is frequently presented as a binary proposition. Supporters describe it as one of the greatest infrastructure achievements of the modern era. Critics describe it as an over-leveraged public works project that sacrificed financial discipline for political ambition. Preemptive infrastructure theory suggests that both perspectives capture part of the truth. The network's early expansion demonstrates that infrastructure can create economic transformation when it is deployed upon foundations capable of generating immediate utility. High-density corridors reduced travel friction, connected labor markets, increased productivity, and generated sufficient passenger demand to sustain continued operation. These routes behave not merely as transport assets, but as economic platforms upon which wider commercial activity could flourish. The later stages reveal a different lesson. As expansion extended beyond economically self-sustaining corridors, the balance between present monetization and future optionality began to shift. More of the network depended upon anticipated regional development rather than existing economic activity. Debt accumulated faster than direct revenues. Maintenance obligations expanded. Policymakers themselves began introducing tighter investment criteria. This distinction is central to preemptive infrastructure theory. The issue is not whether infrastructure should precede demand. The issue is whether the infrastructure possesses sufficient present-day utility to protect the downside while waiting for future optionality to emerge. The rule of priority exists precisely to preserve this discipline. Future opportunity should never depend entirely upon unsecured speculation. Infrastructure should earn the right to expand by demonstrating that each successive layer strengthens rather than weakens the economic foundations beneath it. Viewed this way, China's railway system becomes more than a transport network. It becomes a valuable economic experiment. Its first phase demonstrates how strategic infrastructure can reduce friction, integrate markets, and reshape an economy. Its second phase illustrates the dangers of allowing expansion to outrun monetization and downside protection. The broader implications extend well beyond railways. The same questions now confront governments investing in artificial intelligence infrastructure, semiconductor fabrication, electrical transmission, nuclear energy, cloud computing, blockchain settlement systems, and digital identity networks. Should these systems wait until demand fully materializes? Or should they be built in anticipation of future economic transformation? Preemptive infrastructure theory argues that this is a false choice. Infrastructure should neither lag demand nor blindly race ahead of it. Instead, it should satisfy three conditions simultaneously. First, it must deliver genuine utility from the day it becomes operational. Second, it must generate sufficient revenue, productivity, or strategic advantage to protect its downside. Third, It should create the platform upon which future innovation, coordination, and optionality can compound. Only when these conditions coexist does infrastructure become truly preemptive rather than speculative. China's experience, therefore, offers a practical lesson rather than a simple verdict. The objective is not to build the most infrastructure, nor is it to minimize public investment. The objective is to build infrastructure that compounds, infrastructure that pays for itself while quietly enabling tomorrow's economy, infrastructure that creates opportunity without sacrificing resilience. That distinction separates strategic infrastructure from speculative infrastructure. It also provides the principal question that this paper leaves for policymakers, investors, engineers, and economists. Can future optionality be deliberately engineered without compromising present-day financial discipline? If the answer is yes, then preemptive infrastructure theory offers more than an explanation of China's high-speed rail network. It offers a framework for evaluating the next generation of foundational technologies that will shape the global economy. Questions for third-party review. Does preemptive infrastructure theory represent a genuinely new framework, or is it a refinement of existing infrastructure and development economics? Is the rule of priority a necessary condition for sustainable preemptive investment, or are there circumstances where unsecured expansion can be justified? How should governments measure the indirect economic value created by infrastructure while avoiding vague or unfalsifiable claims? Does China's high-speed rail network validate the principles of PIT during its early expansion, while illustrating the consequences of departing from them later? Can the principles of PIT be generalized beyond transport infrastructure to artificial intelligence, semiconductor manufacturing, electricity grids, blockchain networks, and other strategic technologies? Where should policymakers draw the line between productive foresight and speculative overbuild? These questions are intended not to defend the theory uncritically, but to invite rigorous examination of its assumptions, boundaries, and broader applicability. If preemptive infrastructure theory withstands that scrutiny, it may provide a useful framework for evaluating how societies build the infrastructure that underpins future economic growth.